Good afternoon, everyone. Yeah, am I audible? Dhanashri, am I audible? Am I audible?
Yeah, sir.
Fine.
Yes, sir.
So we'll start with investment management. I started with a new module yesterday or a new concept yesterday called bond valuations. We have seen what is a bond, what are the features of a bond, okay, what are the different types of bonds. All these things we have seen in the yesterday's session. Okay, and we came to a conclusion that bonds do not carry risk. Okay, and bonds are supposed to be safe because you know how much you're going to invest, you know how much you're going to earn, you know when you're going to earn. So all these things are pretty much predetermined. So it is said that bonds are generally risk free, or it is said that bonds do not carry any risk. This is a general understanding between all investors or all those people who think that investing their money in bonds is safe. But the fact of the matter is, this is not true. Bonds do carry certain amount of risk, and what are the various types of risk that are associated with a bond is what we are going to discuss in this particular class. Is that clear? So, today morning we had a session with Tangaraja, and he did mention one word, that investing your money into debt mutual funds is safe. He did not say the word risk free, but he said comparatively it is safe. But is investment into debt instruments or is investment into bonds, is it really risk free? Is what we are going to find out. Clear? Now, in this particular slide, this is a very uh, frequently asked question, and the question usually comes as, please note down the question. The question comes in this particular way: stocks are supposed to be risky, bonds are not. This statement may not be true. Kindly explain. This is how the question comes in the exam. I repeat, stocks are considered to be risky, bonds are not. This statement may not be true. Explain. This is how the question usually comes as far as bond risk management is concerned. And the answer for this particular question is available on your screen. These are the various types of risks that are associated with the bond. So one by one, we are going to understand what are the various types of risks that are involved as far as bond is concerned. The first type of risk that we are trying to understand is a concept called as interest rate risk. Clear? So I'll just blow up this screen, and now we'll see what are the various types of risks that are associated with a bond. The first type of risk that is associated with a bond, we call it as interest rate risk. Okay, and you can see that, you can see some diagrams here. It says if interest rates go up, the price of the bond goes down, and if the interest goes down, the price of the bond goes up. In other words, in other words, interest rate is inversely proportional to price. In rate of interest is inversely proportional to price. This is what we are trying to understand. So let us take an example. Okay, let us say Dhanashri has purchased a bond by paying 1000 rupees, which carries a rate of interest of 10%. Dhanashri, please pay attention. I'm going to ask you a question. Dhanashri has purchased a bond worth 1000 rupees face value. Rate of interest is 10%. The bond is going to mature after 5 years. Clear? So, in the first year, Dhanashri receives 10% rate of interest on 1000 rupees. What is 10% of 1000 rupees, Dhanashri?
100, sir.
100 rupees. So you receive 100 rupees, you are happy with it because you have got 100 rupees, right? Fair enough. Now, I issue another bond, and now Rashmi comes forward and purchases this particular bond, which is worth 1000 rupees, but rate of interest is not 10%, rate of interest is 12%. Now, if Rashmi is purchasing a bond which is worth 12% rate of interest, what will happen to the price in both the cases? Dhanashri, tell me, you have got a bond which is paying 10%. Rashmi has got a bond which is paying 12%. What will happen to the price of your bond? The rate of interest has gone up from 10%, it has gone up to 12%. What will happen to the price of the bond?
So rate goes down.
Why? Why will the rate go down? Is for the simple reason, why will anyone come to you, Dhanashri, to purchase a bond which is just paying 10% when they know that in the market there is a bond which is available which is paying 12%? Why will anyone come to you? Nobody is going to come to you. So if nobody is going to come to you, and if you still want to sell that particular bond in the market, you have to reduce the price of that particular bond. That means you have to put a discount value on that particular bond. Only then people are going to come forward and purchase your bond. So if the interest rate goes up, the bond prices always go down. That is the reason we say there is a inverse relationship between interest rates and the price. Another example on the same slide. I want Pradeep Gauri to answer this question. Pradeep, Dhanashri has a bond which is paying 10% rate of interest. I issue another bond. I issue another bond. I issue another bond which is going to pay only 8% rate of interest. Please explain why will the price go up when the interest rates are going down? I want Pradeep Gauri to answer this question. Pradeep, are you there? Pradeep, are you there? Okay. So I'm marking Pradeep Gauri as absent because he has just put on. Okay, he has clicked the link and he is not available. So I'm marking an absent today. Let me see who else is there. Sushmita, can you please answer this? Sushmita Baragli. I want all of you to come in video mode, please. Yeah, Sushmita, please answer this question. My question is, Dhanashri has a bond which is paying 10% rate of interest and she has purchased this particular bond for 1000 rupees. I am offering another bond to you which carries a rate of interest. What will happen to the price? Sushmita, can you answer this question? Okay. Sushmita Mane, can you answer this question?
So repeat the question once more. No?
The question is, Dhanashri has a bond which is worth 1000 rupees and the rate of interest on that bond is 10%. Okay, maturity is 5 years. I issue another bond, rate of interest is 8%. Can I sell this particular bond at 1000 rupees? Is my question.
No, sir.
Then why will the price go up? Is my next question.
Price. Because the interest rates have to go up, sir.
No, there is an inverse relationship. If interest go up, price has to go down. I am saying I am putting my interest rate down. Why should the price go up? See, when I am offering a bond which is at 8%, price should go down, right? Because I am getting earning less. But on the other hand, I am saying
Yes.
that the price is going up. Why is the price going up? So Swapnil, can you explain? Swapnil, can you explain, please? Why will the price go up?
Sir, to match the interest, so because he's getting it at a loss, so to match that loss, the price should go up.
No, what you say is correct, but basically what happens is the demand for the bond that is held by Dhanashri, that will increase. There will be a demand for that particular bond. Why? Because Dhanashri is having a bond which is worth 10%, and I am offering you a bond which is worth only 8%. So why will you come to me when you know that Dhanashri is ready to sell the bond for 10%? Why will you come to me? You will never come to me, right? You will always go to Dhanashri because the rate of interest with what Dhanashri has, okay, that is more, and that is the reason there will be a more demand for the bond that she has, and that's the reason bond prices always go up. Okay, so if interest rates go up, price goes down, and on the other hand, if interest rate goes down, the price also keep the price goes up. So we say that there is an inverse relationship between interest rates and the bond prices. Clear? So this is what you have to draw inference from this particular slide. Next, we talk about inflation risk. Okay, when we talk about inflation risk, there is a direct relationship between interest rates and inflation rate. It says that whenever inflation rate goes up, the interest rates always go up. The reason is inflation is nothing but you are paying more money to get the same thing. That is where inflation keeps up. Say, for example, you look at vegetables itself. In the last week, any vegetable in the market had gone up almost 25%. That means, I'll just take an example of a simple thing. Tomatoes, which are available for 20 rupees a kg, had gone up almost to 100 rupees per kg. Why all of a sudden? Because there was lesser supply of tomatoes. And because when there is a lesser supply of tomatoes, what happens? The price increases. You know that it is not worth 100 rupees. 1 kg of tomatoes are not worth 100 rupees. You know that. But still you purchase it, which means you are ready to spend. And whenever you are ready to spend, what are you doing? You are degrading the power of money. And when you degrade the power of money, you are indirectly pushing the inflation to a higher level. So if the government comes to know that unnecessary the price of food commodities, the price of properties, the price of gold, the price of any asset is unnecessarily increasing, okay, what does the government do? The government will increase the interest rate. What happens when the government increases the interest rate? There might be some people who will feel that let me not spend this money, okay, on buying certain goods or services, but rather I will invest this money into some investment avenue because the rate of interest are going up. So those many people will move out of the market. If those many people move out of the market, naturally inflation levels will keep down. So this is a central government policy wherein if the people feel or if the government feels that inflation is going up, the interest rates will naturally be increased. If the inflation is going down, the interest rates will always go down. That is a relationship between inflation and interest rates. Clear? Please understand. There is a direct relationship between inflation and interest rate. There is an inverse relationship between price and interest rates. Clear? Other things are quite self-explanatory. You can understand this. I think in my previous class, I did mention to you what do you mean by nominal rate of interest and real rate of interest, right? Real rate of interest is the actual rate of interest, and nominal rate of interest is the actual rate of interest that you pay. I'll just give you an example for those of you who don't know. I'll take an example of an education loan itself. Suppose you have taken education loan of 2 3 lakh rupees at 10% rate of interest. Per year, what would be the rate of per year? What would be the interest? It would be around 30,000 rupees as interest. But if you had taken the same loan in Japan, if you had taken the same loan of 3 lakh rupees in Japan, the rate of interest was just 4% or 3%, right? So what is 3% of 3 lakh rupees? You would have ended up paying only 9,000 rupees in a year, whereas in India, you are ending up paying 30,000 rupees a year. What is the reason for this? Real rate of interest in India and Japan is same, but in Japan there is no inflation. Okay, but in India we have a lot of inflation. So this extra money that you are paying, whatever extra money that you are paying over and above 9,000 rupees is nothing but an inflation amount that you are paying. That is what we call as nominal rate of interest. So whenever you take any loan from any bank or any financial institution, the rate of interest that is going to be applicable to you is the nominal rate of interest, which includes a certain proportion of inflation value also. If you really want to know what is the exact interest rate, then what you need to do, whatever is your interest rate, you write it down minus the current inflation rate that is prevailing in the country. Whatever answer that you get, that is the real rate of interest. That is the actual rate of interest that is supposed to be paid, but you are paying more. Why? Because there is inflation in our country. Are you able to understand? This is the whole logic of inflation risk. And this equation was given by a very famous person. His name was Fisher Black. So this equation is called as a Fisher effect Fisher effect equation. Is that clear? Any doubts in this particular slide?
No, sir.
Sure? Okay. Next. Then we have something called as the default risk. Okay, we have something called as default risk. Okay, now what is a default risk? I'm not sure you were born in that particular time frame, but I was there in that time frame. There was a major fraud that took place. Okay, and the name of the company is called CRB Capitals. Okay, the name of the company is called CRB Capitals. I'll explain you the fraud first, then naturally you will understand what do you mean by default risk. There was a fraud that was created by a company, and the name of the company is called CRB Capitals. Basically, the owner of that particular company, his name was CR Bansali. Okay, so CR Bansali or CRB Capitals was the name of his company, and this company used to borrow or take money from people and invest into stock markets. So this is how the company used to function. Now, what happened is this particular person or this particular company gathered a lot of money from small investors and or retail investors. He gathered a huge amount of money from all these people, and instead of investing his money into stock markets, he took this money and ran away. Okay, and he assured that if you invest money in my company, I will give you a sure shot return of 15 to 17% every year. This was his promise. So based on his particular promise, a lot of people paid money to him with an intention to earn more returns. And this particular person, CR Bansali, took all the money and ran away. Okay. Presently, he's in Dubai. He's under Interpol. So basically, he's in Dubai and he has been found and he has been traced there. So he ran away with all the money. But the whole problem is people who invested their money in this particular company lost all their money. Why? Because the company defaulted on its payment. The company did not pay the money on time, and as a result, what happened? There was a default risk on this particular company. Clear? Now, after this particular fraud, all of a sudden, Reserve Bank of India and Security Exchange Board of India came up with strict guidelines that whoever issues any bond has to first satisfy certain criteria, and the money the money part of it has to be routed through us. In the other sense, we are going to govern how the money is going to flow out. So these are all after effects of the fraud that took place. But before the fraud took place, people never knew that there could be something called as default risk. And this particular company took the money and ran away. The owner ran away with this particular money. And that led to a default of this particular bond. Clear? Any doubts in understanding the concept of default risk? Default means not paying on time. That is what we call as default. If you take a loan and if you don't pay on time, what happens? You become a defaulter of the bank. On some similar basis, if you give money to somebody else and that somebody else does not return your money to you, he is a defaulter, no doubt. But what risk you face is you face the risk of default, right? That is what we are trying to understand here. Any doubts in understanding default risk?
No, sir.
Okay. Next, we have something called as the marketability risk. See, any asset that you have should be easily converted into cash, right? Should be easily converted into cash. Now, there is a marketability risk because if uh, you know if you're offering a bond, if you're offering a bond, when the interest rate goes up, when the interest rate goes up, the price is supposed to go down, right? This is the universal rule as far as bond valuation is concerned. But on the other hand, if you are not ready to sell the bond at a discounted price, what happens is you are not able to convert your bond into quick money. And as a result, the risk that you're going to face is called the marketability risk. Are you able to understand? The risk that you're going to face is called as a marketability risk. Or for that matter, if I can give you another example, suppose you have given money to a particular company in terms of bonds. That means a company wanted money, they made a bond issue, you invested your money into that particular company in terms of bond holdings, and the company said that after 5 years we will return your money back to you along with whatever interest has been agreed, right? Now, over a period of time, the company started underperforming, it started incurring losses, it was on the verge of closure. But the problem is you have invested your money in that particular company. Now you are not able to recover that particular money from the company. Okay. If you go and decide to sell off the bond, that means a paper that you have, if you decide to sell that particular bond in the market, nobody is going to come forward to purchase your bond for the simple reason there is no liquidity in that particular company, there is no profitability in that company, there are no growth prospects in that company. So why will anyone purchase your bond? And when you are not able to sell your bond in time, the amount of risk that you face or the kind of risk that you face is called as marketability risk. Any doubts in this?
No, sir.
Next, we have a concept called as callability risk. Okay. Callability risk is nothing but whenever any company, any government issues a bond, there is a clause in that particular bond which says that we are issuing the bond for n number of years, or let us say we are issuing this particular bond for 10 years. But during this 10 years of tenure, anytime we may call the bond back, right? Suppose, and they don't specify after how many years or so, they just say this bond has an option to be called back during these 10 years, anytime during these 10 years. Now, this creates a uncertainty in the minds of the investor, because, say for example, Rashmi, you have invested. Let us suppose that I am coming out with a issue, a bond issue, wherein I say you can invest your money in multiples of thousands. The rate of interest that I'm going to assure you is around 15%, 1 5. Okay, and maturity period would be 10 years. But only condition is I may call the bond anytime during these 10 years. Rashmi, if this offer is given to you, would you come forward and invest your money into this particular bond?
No, sir, not really.
Why?
So because they can call back the bonds anytime, right?
Yes,
So there would be no surety that I can earn out of it.
correct. Because you don't know when the bond is going to be called back. Probably after 1 year or after 2 years, I may call the bond back. So if I call this particular bond back, Rashmi is going to lose money from the time I have called back. Okay, suppose I have a 10 years tenure, I pay the interest of 15% for first year. What is 15% of 1000 rupees? 150 rupees. So Rashmi gets 150 rupees. In the second year also Rashmi gets 150 rupees. But during the start of the third year, I recall the bond back. So if I recall the bond back, what happens? Rashmi is going to stop getting 150 rupees for the remaining 8 years. So there is an uncertainty that is created in the mind of the investor, and that is the reason the amount of risk or the type of risk that Rashmi is going to face, this type of risk we call it as callability risk. Clear? Any doubts in this, Rashmi?
No, sir.
Next, we have a concept called as reinvestment risk. Now, what happens here is, let us take the same example. Rashmi, you have got a bond which is worth 1000 rupees. Rate of interest is 15% fixed for next 10 years. You are going to get 10%, 15% as a rate of interest. So every year you will receive, okay, so every year you will receive around 150 rupees, right? Now this 150 rupees is too small. I'll just increase the value. Rashmi, let us suppose that you have invested say 1,50,000 rupees with me, or let us say you have invested 1 lakh rupees with me. Clear? So 1 lakh, on 1 lakh I have to pay 15% as a rate of interest every year. What is 15% of 1 lakh?
1,500, sir.
15% of 1 lakh.
No, sir, sorry, sir. 15,000.
15,000. So every year, Rashmi, you are supposed to get 15,000 rupees out of this particular investment. Am I clear?
Yes, sir.
So every year, at the end of every year, I will pay you this 15,000 rupees to you. Now you have you are going to face another type of risk, and this risk we call it as uh, reinvestment risk. The reason being, the risk that you are going to face is a reinvestment risk in terms of whatever 15,000 that you are getting as interest, you want to reinvest this 15,000. Now when you reinvest this 15,000, you want 15% only as a rate of interest, because that is what you are already receiving. But you come to a conclusion that today nobody is offering 15%, you are going to get only 10%. So which means your earning capacity has come down from 15%, it has come down to just 10%, which means you will lose 5% as a return on your reinvestment. This type of risk that you face is called as reinvestment risk. Am I able to convince you, Rashmi?
Yes, sir.
When I say Rashmi, it is not only Rashmi, it is everyone. Just because I have taken her name, I am specifying her. Any doubts in this concept called as reinvestment risk?
No, sir.
Okay, let me get some other people. Is Tanas there? Yeah, Pradnya, can you explain me what is reinvestment risk? Can you explain me, Pradnya, what is reinvestment risk? Pradnya is also not here. Renuka, can you explain me what is reinvestment risk? Please come in the video mode, everyone. I want everyone in the video mode, please. You just keep the system on and you roam about in your house, then you will not understand. And believe me, second eye I am not going to give you so easy. You'll have to really struggle for second eye. Because of late, everyone is under the impression
Excuse me, sir.
switch on the system and you're not available to listen to the lectures. Please switch on your video
Excuse me,
mode.
sir. Excuse me, sir.
Yes, Swapnil.
Sir, just a question. How can an individual buy a bond? Is it like through a broker or online?
No, today bonds are available. See, there is something called as bond issue. Some companies call it, some companies call it as debenture issue. Some companies call it as bond issue. Okay, some prominent bonds I will tell you. You're from Goa, right, Swapnil? Swapnil, you're from Goa, right?
Yes, sir.
Okay. Uh, all of you
Yes,
are,
sir.
especially the coastal belt. Once upon a time, there was no railway in the entire coastal belt, right? And now you have Konkan Railway, starting right from Mumbai going up to Kanyakumari. The entire coastline is covered by the railways. And by the way, Konkan Railway is not a part of Indian Railway. It is a separate entity on its own. I hope you know that. So when money was required to construct this particular railway, the government of India did not have money, nor any bank gave any money to the railways to construct the railway line. So what did the railways do? They created an entity called as Konkan Railway. Okay, and through this particular entity, they issued bonds. They said whoever wants to invest in our entity can come forward and invest. So a lot of people in the coastal belt thought that this is a good investment opportunity, and a lot of people invested their money into Konkan Railway bonds. Konkan Railway assured that we will pay you 17% rate of interest every year for next 15 years, 1 5. For next 15 years, we are going to pay you 17% rate of interest. Now, anywhere in India you go, you cannot get 17% rate of interest assured, right? But this entity was offering it, and that is the reason a lot of people put their hard-earned money into this particular investment avenue. And by the way, this money was paid back. Once the railway started functioning, the money was slowly paid back to the investors. So there are entities who issue bonds. One more example, if I can give you, Swapnil, is there was a dam that was constructed in Gujarat called as the Sardar Sarovar Nigam Limited. Okay, so there was no money with the government of Gujarat. There was no money with the government of Madhya Pradesh. There was no money with the government of India also to construct a dam on that particular river, on Narmada River. So what happened is that particular entity issued bonds, and people of that those two states put in their money to see to it that the dam comes up. Likewise, you have multiple bonds that keep on coming up, and whenever bonds are being issued, it is always been reported into Financial Times, into Economic Times, that such a entity is coming out with a bond issue. If you want to apply for it, they give you a today they give you an online link. You have to just click on that link and then you can buy that particular bond. If you want bonds which are already been issued, you can go to NSE wholesale debt market. You can go to NSE wholesale debt market. There you can buy and sell bonds which have already been issued prior. Okay, so that market is also feasible. Swapnil, I hope I have answered your question.
Yes, sir.
Any other thing?
No, sir.
So we'll stop here. And in my next class, that is tomorrow, we will start with how do we put a price tag. Okay, how do we put a price tag to the bond? When the interest rate goes up, I told you that the bond prices come down. How much should the bond price come down? Or if the rate of interest goes down, how much should the bond price go up? There is a calculation for that. We need to understand those particular calculations, and that is where bond pricing comes into picture. So all these things, okay, all these formulas and other things is what we are going to see tomorrow and in the upcoming classes. Is that clear? So we are going to stop here for this class, and tomorrow we'll continue from where we have stopped. Please understand, there is a lot of complaints that have been raised that you are